On July 11th, 2026, the European Commission published a 200-page document that had been 5 years in the making, a final regulatory framework for the digital euro. It is easy to let a document like that pass by a bureaucratic background noise. It shouldn't. This is the moment a genuinely new form of money for over 300 million people moved from a research point into a defined, dated, legally structured plan. The distinction that matters here is one most people skip past. Money in your bank account today is technically a liability of your commercial bank. A promise from that bank to you, not a direct claim on the central bank itself. A digital euro would be different. A direct liability of the European Central Bank carrying the exact same state backing as the physical banknotes in your wallet, just issued and held electronically. It is not a cryptocurrency and it's not a private payment app like a card network. It is a digital cash in the most literal legal sense the purchase can carry. The newly finalized framework answers a question that had remained genuinely open for years. How much digital euro would any individual actually be allowed to hold? The answer, confirmed in the July 2026 framework, a holding limit of 3,000 euros per person. Payment under 50 euros are designed to remain fully anonymous, closely mirroring how physical cash works today, while larger transactions require identity verification consistent with existing anti-money laundering rules. ECB President Christine Lagarde has been notably emphatic and repetitive on one specific point. The digital euro is, in her words, in no way intended to replace cash, declaring flatly that cash is queen. This isn't just rhetorical reassurance, it is written directly into EU regulation, which requires euro area countries to keep physical cash genuinely accessible and explicitly prohibits businesses from refusing it. The digital euro is being built, at least as formally structured, as an addition to the existing system, not a replacement for it. The genuine strategic motivation stated plainly in ECB communications has less to do with domestic convenience and more to do with a dependency the institution finds increasingly uncomfortable. Europe's digital payment infrastructure runs almost entirely through the American companies Visa, MasterCard, PayPal, Apple Pay, and March 2027-2025 ECB statement put it directly. Introducing a digital euro has become imperative precisely because cash usage is declining and private, often non-European stable coins are gaining ground. This is, in essence, the exact same sovereignty logic behind Europe's IRIS satellite program discussed elsewhere in this series, a deliberate move to reduce structural dependence on infrastructure controlled by a single foreign country or company. Support for the digital euro is not unanimous, and the primary objection deserves to be taken seriously rather than dismissed as simple institutional resistance. Commercial banks have raised a real structural concern known as intermediation. Ordinary depositors can hold money directly with the central bank instead of commercial banks. Banks could see a meaningful share of their deposits base migrate away, weakening the base they currently rely on for lending. The 3,000 euro holding cap is, in significant part, a direct policy response to this exact concern. low enough to function as everyday transactional money, deliberately too low to function as a genuine substitute for a commercial bank savings account. The European Banking Federation published its own cost study in March 2026, specifically modeling the financial implications for banks required to build and integrate this new infrastructure. Europe is a comparatively late mover in this space, which gives it the advantage of learning from others. Results the retail central bank digital currencies that have actually launched elsewhere in the world share a consistent, sobering pattern. Real but small adoption has generally lagged well behind official projections in every country that has gone first. China's CNY remains even after years of active promotion, formally in pilot status rather than full nationwide rollout. This global track record is precisely why the ECB has been careful to frame the digital euros timeline conservatively. Even with the Governing Council's approval to proceed in 2026, officials have stated a live circulating digital euro remains at least 2 to 3 years away, with pilot transactions targeted for 2027 and a full rollout realistically expected around 2028 or 2029. For most euro area residents, the practical near-term change is minimal. Nothing about how you pay for anything shifts before the pilot phase begins in 2027 at the earliest. What has genuinely changed with this July 2026 framework is regulatory certainty. The privacy tiers, the holding limit, and the offline payment functionality are no longer open design questions being debated behind closed doors. They are now specific published commitments that banks, payment companies, and eventually consumers can actually plan around. Money has changed from coin to paper to plastic card to phone tap, and each transition arrived with its own mixture of genuine benefit and genuine anxiety about what was being given up in the process. The digital euro is, at its core, a deliberate, carefully negotiated attempt to make sure the next transition happens on Europe's own terms, rather than simply arriving unplanned through whichever private company got there first. Thank you so much for your presence. Looking forward your questions, your reflections, your experience, your personal opinion about this regarding this transition and previous transitions as well. Looking forward to welcome you in another deep dive.